Good morning, everyone. Welcome to the webinar with Troy Brown and Yanni Niebuhr. Turn your ideas into reality, legal and financial moves for lasting business success.
Hannah, thanks for having us, Troy. I'm really excited to do this.
Absolutely, Yanni. Thank you, Hannah.
If you have any questions during the webinar, anytime you can drop a question in the question box and I can ask them throughout the webinar or at the end.
Perfect. Let's get started.
So the first scenario, which we're going to go through a few different ones, is opportunities and threats. I'm going to read it out and then Troy and Yanni will speak to it.
Okay.
So the scenario goes, Miss A, Mr. B, and Mr. C form ABC LLC as a limited liability company, of which they are the members. ABC LLC will be in the business of doing commercial construction using Miss A's expertise in that realm. The three partners truly respect each other, but they also value their freedom to pursue business ventures independently of ABC LLC. Ms. A contributes to 60% of the startup capital, Mr. B contributes 30%, and Mr. C contributes the remaining 10%. No member enjoys any preferential rights. The three members draft an operating agreement that contains a host of inspirational platitudes, but little substance. For instance, the agreement provides that ABC LLC will be run by management leaders and visionaries. After the company is formed, it hires Jay to help run the business. However, Jay is not a member. Shortly after joining the company, Jay wishes to hire an employee, a matter the operating agreement does not address. The company regularly hires and fires employees. Nevertheless, Mr. B and Mr. C do not approve Jay's decision here. Jay hires the new employee anyway. Meanwhile, the company is experiencing financial distress, so Mr. B suggests making Jay a member in exchange for a significant cash contribution. Despite the company's current financial turmoil, Jay is initially willing to purchase a membership interest. The operating agreement does not address the addition of new members. Ms. A and Mr. B vote in favor of making Jay a member, but Mr. C votes against it. After learning of the discord among the members, Jay withdraws his offer to purchase a membership interest, though he continues to help run the business.
A lot to unpack there, and I appreciate you reading that out.
Thank you, Hannah.
Interesting. Go ahead, Troy.
Want to dive right into this, Yanni? Look at the first question.
Yeah, let's see. What are the thoughts here? So the first one being ABC LLC. Is it a member managed or a manager managed company? So I think the first thing is, what does that even mean?
What does that even mean? Absolutely. And I see this issue a lot. I see all these issues a lot in my practice. And by way of background, again, as a partner with Albers and Associates in our civil and business division, I represent a number of different kinds of companies, construction companies, franchises, accounting companies, insurance companies, you name it. I've represented. I also do litigation for those entities as well. In forming a company, it's important to think about any number of different aspects, right? And forming a company is relatively easy. You're filling out for a limited liability company articles of organization, submitting those to the State Department of Assessment and Taxation. That's the easy part. And you don't need a lawyer for something like that, right? But it's when we get into the corporate governance aspect that these kinds of questions become incredibly relevant. So a member is the term for an owner of a limited liability company. When we think of a corporation, we're thinking about a shareholder, but for a limited liability company, it's a member. So the first question is really looking at who is running the company. Just because you own an interest in a company doesn't mean you're the one running it. So in this one, we have the members. They form the company, and they have what we call an operating agreement. With limited liability companies in most parts of the country, I can't think of any exceptions. You don't have to have an operating agreement, but it's a good idea to have one because if in the absence of an operating agreement, you're looking at the Maryland Corporations and Associations Code, the Limited Liability Company Act, which is very, very skeletal. It
Right.
references operating agreement throughout the entirety of it. The statute wants you to take the reins and determine how the company is meant to be run. Specifically, Maryland Corporations and Associations Code Section 4A 402A1 states in pertinent part the manner in which the business and affairs of the limited liability company shall be managed, controlled, and operated, which may include the granting of exclusive authority to manage, control, and operate the limited liability company to persons who are not members. So in this particular case, it could be a member managed company or a manager managed company. It's really up to the members to determine how they want it run.
Right. And it sounds like, based on what Hannah showed us there, they don't know which way they want to go. Where you had Mr. B and Mr. C really feeling like they had a member managed type agreement where they wanted to be the ones in charge, making the decisions. They mentioned they're doing the hiring, the firing, the decision making. And now all of a sudden they brought in Jay, which they say, okay, Jay is going to be doing some managerial roles. Well,
Right.
what are those roles? What are they defined as? And Jay makes it seem like, well, it's a manager managed LLC where I'm in charge, I'm handling things. You guys are more taking a back seat to how things are set up. So to your point, some companies don't have that operating agreement on hand or on file. They're letting the laws happen in the various states, and now they've already got a problem, and it's day one.
And the problem gets even worse, right? Because they have an operating agreement, but it's written in a very aspirational and incomplete
Mm-hmm.
way, right? The most
Right.
appropriate verbiage in the operating agreement states ABC LLC will be run by management leaders and visionaries. It's ambiguous. What is a management leader? So lawyers love stuff like
I
this,
was going
right?
to say,
Because
lawyers, you got to be loving the fact that that was ambiguous there and be like, I'm going to get into that real quick.
depending on who I'm hired by, I may argue one way or the other. I think the safest way to interpret that, because of that management word,
Mm-hmm.
would be to argue that the members hired Jay specifically with the purpose to manage the company. And again, we can look at that verbiage to support this, but certainly if they wanted the company run by the members, the owners, they had the opportunity to put that in the operating agreement, and they should be clear about it. And
Mm-hmm.
let me say this, because we'll be talking about the importance of operating agreements throughout this presentation. An operating agreement should not be written aspirationally. There are other places to write aspirational platitudes. An operating agreement is not one of them. It gets confusing, it gets ambiguous, and we don't want it to operate that way. So if they want it to be member managed, they should state that. If they want it to be manager managed, which I guess is the point of that statement, then they should be even clearer about that as well.
Okay. So, on your professional opinion, you think that this is more of a manager managed company based on the vague writing that you're seeing here?
That would be my primary support for that conclusion. The second one would be what exactly was Jay hired for?
Right.
Um, and certainly, if it went to the level of litigation, deposing the members and asking them very clearly in a number of different ways, what was Jay hired to do? Does he have an employment agreement? Wasn't hired to do nothing. It seems like he was specifically hired to manage the company.
Right. Which I think purposely segues us to the second question is like, it depends. But,
Right.
we're not really seeing how was he hired? What was he empowered to do? What was in that employment agreement? And so there are so many things and so many places that can be gotchas,
Mhm.
unfortunately, here. And so from the scenario, but I was thinking, was there authorization to unilaterally hire? Maybe, maybe not. But now we're seeing strife, and it's the very beginning of how the company is formed. And when you have something here saying, all right, at the bottom, I'm saying, after learning of discord with the members, Jay is withdrawing offer to purchase. You have potentially a rock star employee that you want
Right.
there long term, and they're seeing the other members having discord. All right, well, now you know what? I'm not going to be tied up and associate myself here. I'm going to be an at-will employee, which may or may not become a problem that comes back to bite you in the future.
That's exactly right. That's exactly right. And again, it goes down to the importance of being very clear in the operating agreement.
Mhm.
What exactly were people hired to do? Who's doing what? And stating those duties very, very clearly. The decision to hire an employee is not specifically addressed in the operating agreement. The facts of our scenario state that the company regularly hires and fires employees.
Mhm.
Again, my argument would be that Jay was hired specifically to do exactly what he did, to hire and
Yep.
fire people from the company. These scenarios happen all the time. They're not academic at all necessarily.
No.
They happen on a daily basis, unfortunately, and clarity is best.
I'm sure. So then the third question here is something that I mean, we see all the time, and I'm sure you see and deal with quite a bit, where you have someone potentially coming on board as a member or a shareholder, and where some of the current and existing members or shareholders like, yep, we want them, and then there's others like, no, absolutely not. And if things are not written into the operating agreement of how you come to a consensus,
Right.
there are issues. So here, the question asked was that can two members have the power to say yes while the third one's saying no? And again, I love saying it depends, but from how it works is was it unanimous? Do you need voting based on ownership? How does it work? And there are pros and cons to both. If you have unanimous voting and Jay were to come in and be a 2% owner,
Mhm.
a 2% member in this case, well, going forward, if 98% say yes, but a 2% member says, nah, I don't want to add anybody else. Now you have a 2% member who's creating all sorts of strife.
That's exactly right. That's exactly right. And once again, it's something that you can specify how decisions like these are made in the operating agreement. But if it's not specified there, you're defaulting back to the Maryland Corporations and Associations Code, and Section 4A601B1 states in pertinent part, in the case of a person acquiring a membership interest directly from the limited liability company upon compliance with the operating agreement, or, and here's where it gets problematic for people who are not specifying what they want, or if the operating agreement does not so provide upon the unanimous consent of the members. So again, you're exactly right, Yanni. If the operating agreement isn't clear, then that 2% owner could certainly have essentially veto power. If you
Right.
don't like what the statute says, then be very clear in the operating agreement.
And so that's the important part. And you just quoted something that if you would have asked me to repeat it, I'm not able to do that whatsoever. And why it's important to have you in their corner of saying, look, you understand how these work. It's when they're coming in and starting it, they're not thinking about that statute and how
No.
that would work if this happens as they grow, add they add members there, and it's just not going to happen. But you've got to be able to find those gotchas before they happen.
And Yanni, you're exactly right. And I like to think of starting a business with multiple members or multiple owners is like a business marriage, right?
Mm-hmm.
And relationships are always fun in the beginning. There's that honeymoon period. We're having fun. We're providing the service or creating the product that we all enjoy. But it's when we get to these decision nodes or issues that can become problematic where these problems creep up, right? And it's better to think about them in the beginning and have them, I won't say pre-resolved, but have the process for resolution solidified very clearly in an operating agreement so that when they do come up, we're removing the discretion. We've already agreed on the process for resolution or voting so that any potential disagreement doesn't become a potential breakup situation. It's much easier to do it in the beginning. And as you and I both know, we know we don't need a lawyer or financial advisor to create a company. But if you want to do things right and avoid problems later down the line, it's best to hire people like us to help business owners think about these decisions before they become a problem.
Right, it's navigating those potholes, which is a perfect segue to saying, all right, now that the
Mhm.
company started, now let's talk about in the in between there. They're building their brand, they're developing it. So we'll bring Hannah back on. We'll move to the next slide and start talking the next piece.
Sounds
So this
good.
is part 2A, success breeds problems.
Mhm.
ABC LLC is thriving, but as the business grows, so do the complications. After a year of success, Mr. B informs his partners about a lucrative opportunity with Mega Software, a large tech company seeking proposals for a new office building. Miss A, whose best friend works there, accepts the job personally, bypassing the company to keep the full profit. She does not inform Mr. B or Mr. C. As ABC LLC faces financial difficulties, Miss A offers a loan of $50,000 to the company with harsh terms, including a high interest rate and an accelerated repayment schedule. Mr. C objects, citing a potential conflict of interest and a breach of loyalty to the company, but Mr. B is inclined to accept the loan. A year later, the company's financial situation improves, and the members vote to issue a sizable dividend despite the company still being behind on debt payments. Jay, the employee who helped with operations, disagrees with the decision and is unhappy about distributing the funds. When the unpaid creditors discover the dividend payment, they become enraged and threaten legal action. In response, Miss A remains unconcerned, insisting that Jay acted on his own authority. However, Jay resigns and the creditors threaten the members directly. Miss A dismisses the risk, claiming liability lies with Jay, not the members, but tensions rise as the operating agreement remains unclear on key matters.
So to your point, Troy, the honeymoon phase has officially ended, and now you're starting to see some real world scenarios about problems that can happen. Right? I mean, they sound far fetched, but unfortunately, and I mean, I know I've dealt with some of these things. Not these specific scenarios, but similar scenarios to this. And I got to imagine you've dealt with this dozens and dozens of times.
Unfortunately, they happen all the time in any number of different industries. Again, these are things that people typically don't want to think about, but again, they're not far fetched. They happen all the time. And let me say this with regard to Jay. While the vote of two of the members would have been insufficient to make him a member because they didn't have unanimous consent, the majority of them, in other words, 2 out of 3, could fire him as a manager. Again, it's another reason why we want to be very clear in the operating agreement as to how decisions are getting made. So this kind of situation happens a lot also, right? Where you have what we call a conflict of interest, where maybe the interest of one person conflict with the interest of the organization because they both have an interest in the subject matter, right? So
Right.
with this, we have the company Mega Software wanting to give an opportunity that Ms. A would love to have, and certainly the company would love to have, right? And therein lies the conflict of interest. Human nature is a powerful thing, as you and I've talked about, Yanni.
Hmm.
Prospect of the company getting this opportunity is obvious, but Ms. A says, well, you know what? This sounds maybe a little too good to be true. I
Right.
can do this by myself and I can make all the money without having to share anything. This happens a lot. You can specify what is supposed to happen in a situation like this in
Hmm.
the operating agreement. And quite frankly, in Maryland at least, the law had been a bit unclear with situations like this, but it's been clarified. So, with an opportunity that the company could take, Miss A should almost definitely bring that to the company for the company to either accept or reject.
Right.
First and foremost, I want to make that clear. There are several duties, fiduciary duties, that
Hmm.
come. Fiduciary meaning that people are in a relationship such that they owe the respective agents, in this case, the co-members, they owe duties, one of them being the duty of loyalty. This isn't something that I should take before offering it to the company. So Miss A is looking to directly compete with a company that she's a member on a fundamental aspect of the company's business. So whether Maryland law recognized an independent cause of for breach of fiduciary duty had been a bit of an unsettled question, but the Maryland Court of Appeals in a July 14th, 2020 case called Plank versus Chernesky, the court said the Maryland appellate courts have not spoken uniformly on this issue and have made seemingly inconsistent pronouncements. But they've made some things very, very clear in that decision. So, in a discussion specifically on fiduciary duties in the context of a Maryland limited liability company, the court stated that managing members of an LLC, quote, owe common law fiduciary duties to the LLC and to the other members based on agency principles. The court said that it agreed with the Court of Special Appeals that under Maryland law, provisions within an operating agreement could alter the existing duties or create other duties that would not otherwise exist. What does that mean? In the absence of anything differing or altering the members' duties to each other, there is a duty of loyalty. So if their operating agreement, if ABC's operating agreement doesn't speak to this issue, then Miss A has breached her fiduciary duty by taking this opportunity. Once again, it's something to talk about in the beginning.
Right.
Should there be something like a right of first refusal? How
Mm-hmm.
that would work? Miss A has come into knowledge of this opportunity. She brings it to the company. The company accepts it. Discussion over. If the
Done.
company rejects it and says, okay, Miss A, we don't want this, we're not going to do it, do whatever you please with it, that's how something like that would work. But again, it's
Mm-hmm.
something for the members to think about and plan within an operating agreement. I've had situations like this. One of my clients owns a construction company. He joined another company with other co-owners. We specifically addressed this issue because there were opportunities that his company may want that the other company may be offered as well. How do we resolve that so that there's no need to go to court or fight over anything? Let's think about it and resolve it in the beginning. It's the most efficient way to handle it.
So the key aspects there are avoiding those conflicts of interest. Here, unfortunately for Miss A, it's just saying, all right, she took on something that could have potentially been beneficial to
Right.
the company overall, which means now you're getting involved in the other aspects of self-dealing, keeping business opportunities
That,
from the LLC. And so you're hitting all those key tenets on the section of loyalty to the company, which is problematic. And again, not spelled out potentially in the operating agreement, which means now we're going and staying strictly to the state law as
mhm.
opposed to what's already been agreed on. So now we're looking at the broad base instead of what is tailored, customized to the actual company.
Exactly. And Yanni, you think about this. I mean, again, I like to analogize business ownership with other people like being in a marriage. It is the closest thing to being married that I can think of.
Mm-hmm.
Imagine how you feel when you find out that your wife, your business partner, is essentially cheating on you. It
Right.
erodes trust, it erodes credibility. It can be difficult to manage a company or own a company with people after you find out about something like this. You've got the immediate situation that you just described, the problems associated with it, and what you have to do, and then trying to carry on the relationship after. It can be incredibly awkward and difficult.
Right. How do you come back from what Mr. C said? You're literally saying, we're saying that you have a breach of loyalty. I don't know about you, but if the other shareholders here, if they said to me, Yanni, you have a breach of loyalty, our relationship is damaged one way or the other, whether or not I did it.
Exactly. And it may be damaged irretrievably, right?
Right. And so that's a problem. So, Hannah, why don't we go to the next slide and see the actual questions here that we have to this one? And so, ironically, the first one I was on that loyalty, which I think we answered here. Um, but on to the second one of violating the loyalty simply by lending to the partnership. I don't think lending in itself is a breach of loyalty. And then this is one here where I think lawyers would chew on when we're looking at it and saying, okay, are those harsh and severe interest rates? Is it an accelerated repayment? Well, that's kind of the ambiguity there too is set up. It's like, well, what's the market look like? It might feel like 7% is terrible, but the going prevailing rate is 9 in the market.
Right.
And so it's kind of, well, Mr. C feels upset about it. It's in the operating agreement, there might be things that discuss, well, if we're going to lend capital, here are the rules, here's the payment schedule, here's the interest rate
Exactly.
that we would attach to it. And it could be something that's not just fixed. It could say it could be LIBOR plus a percent. And so it's variable based on what's happening in the world, because you might do this in 2025, but it might not come into practice until 2040.
Yanni, I completely agree with you. And I think Maryland law is pretty clear about this as well. So there wouldn't be a breach of fiduciary duty with lending money to the company.
Right.
Maryland Corporations and Associations Code Section 4A 405 provides that a member can lend money to a company. And in that context, the obligations are the same as somebody who isn't really affiliated with the company, right? So according to that, Ms. A could lend money to the company and expect a particular interest rate. I think the important thing from a corporate governance perspective is that Ms. A probably should not be allowed in the discussion in regard to whether the company accepts it, because then she'd be on both sides of the transaction. She'd be
Right.
both the lender and helping to make the decision as to whether the company accepts that loan. So as a matter of corporate governance, Ms. A should abstain from having any vote with regard to whether the company accepts the loan or not. Mr. B and Mr. C should have that discussion, have that vote, and that would avoid any conflict of interest or perception of impropriety. But it happens all the time that a member, for any number of different reasons, has to loan money to the company. And once
Mhm.
again, you can specify within the operating agreement how that occurs, how it gets paid back, making sure that it's commercially appropriate and that there is no taking advantage of the company. Um, Companies may go through hard times where additional money needs to be put in. They may want to expand operations. They may want to acquire some asset or acquire another company.
Sure.
Ways to resolve this before it becomes a problem, and that's the one of
Exactly.
the points. Mhm.
And and just on to elaborate on that, it's also the human aspect. You're now telling the largest shareholder of this company, no, we don't want your money. No, we don't agree with this, how it's going to be set up. And now things could be awkward with a person who, based on everything else, has a large control of how everything's going to be run going forward. So it creates potential animosity and conflict going forward because of something that was very simple to add in the very beginning.
And you raised another good point, Yanni. Now, we talked about the percentage of the capital contributions in the beginning,
Mhm.
60, 30, 10, but that doesn't necessarily correspond to their membership interest.
Right.
The the capital contributions will determine the profits and losses of the respective members. I'll put in 60% of the money, I get
Mhm.
60% of the profits and losses, but they need to specify what their ownership interest is. Is it
Mhm.
one third for each of them? Are their ownership interest corresponding to their capital contributions? Have they talked about that? Because as you
Right.
and I both know, memories can differ. I thought because I was putting in 60% of the money, I own 60% of the company. Mr. B could say, well, we're all friends, we're all equals.
Yeah.
I thought we were doing 33 and a third for all three of us.
And we're
All
all doing
these
a third of the work. We're getting a third of the ownership, but you can have the profits. But when it
right.
comes time for sale, we're a third there. And again, strife, issues, problems because it's not written down.
That's
And
exactly
so
right.
it goes down into the next piece here, talking about, a dividend is issued. And I think this is a pretty big one, but still owing money to the creditors there. And it's just, can you have personal liability with that? And, you mentioned the word fiduciary, and those fiduciary duties here become a large a portion here of becoming problematic. If
Sure.
you've now issued profit distributions and being backdated with some of these payments, that's the big issue here and you see it a ton of times on the state level of the insolvency requirements and all those things. And I'm not even going to attempt to speak to that. That is a shameless plug for you and saying, talk to Troy. But there's a lot there that could become a giant problem if a creditor sees, hey, we haven't been paid,
Right.
but now you're taking income and profits and paying yourself.
Indeed. You're exactly right about that. And it may seem like a good idea at the time. Hey, look, let's let's get our dividends and cut and run. But it's not a good idea. If it
No.
were to make the company insolvent, requiring that the company be dissolved or go out of business, you would have to notify the creditors. If they have a suspicion that the members have accepted a dividend when they knew that the company was insolvent, yeah, there may be successor liability. There may be any number of different things that could happen. There's a concept called piercing the corporate veil. If for
Hmm.
some reason the members were using the company as a personal bank account and misusing the company as, again, a personal bank account, then yeah, they could have serious liability in a personal capacity. It's a bad idea to try to bleed the company to avoid creditors. When companies do that, things typically go wrong for the owners.
So have there been any other solutions that these members could have done instead of taking those profits and distributing them down? Were there other alternatives that they could have set up? Say, okay, we're going to make sure this happens down the line, or set up instead of running afoul of those creditors, in your
Oh,
opinion?
sure, absolutely. Dealing with creditors is something I do a lot, period, for any number of different reasons. Um, Times change and businesses go through rough times. One of my clients recently went through a situation where he defaulted on a nearly $2 million loan. And I've been working for the past year to resolve that issue in a manner that allowed him to keep the asset and repay the loan. Most creditors, in particular lenders, they're not looking to sue. They're not looking to fight. What they want is money. And
Right.
a lot of them are incredibly open to some kind of workout, some kind of repayment schedule, and some of them will even offer discounts, whether it's off the principal or off the interest, some kind of extended repayment plan.
Hmm.
You don't know unless you try. And it's always best, and in my opinion, the right thing to do. Contact that creditor, let them know, hey, look, we're going through a rough patch. Can we rework the loan? Can we do something? What can we do so that we can stay in business and repay the debt? A lot of them are incredibly open to working something out. They're prepared for it. It's part of the
Right.
business.
So part of that renegotiation, whether you're deferring those distributions, saying, look, once the debt's resolved, then we'll take it, or you could even say, oh, we're just going to take the profit and reinvest it in the firm, and say we're just going to keep building it there, but we're not distributing
Right.
it to ourselves. So there are options there instead of making a big mistake and saying, well, we're not going to pay the creditors, we're going to take a bunch of money, and things are going to get legally awkward.
That's exactly right. And once again, at the risk of beating what may be a dead horse, many operating agreements specify when it's appropriate to make a distribution.
Hmm.
Uh, Based off the revenue, the profit of the company. It's not simply done, hey, we've made this amount of money this month, we're going to give ourselves a fat paycheck. It's based off the performance of the company and typically in light of what it has outstanding. It should be done in a way that is predictable and obviously fair to what's going on. But again, you can set those levels in the beginning, and it's best to do so.
Perfect. And why don't we have you come back on board and then take us to our next scenario?
All right, this is part 2B of Success Breeds Problems. As ABC LLC grows, it begins to attract larger commercial construction contracts and opportunities for expansion into new geographical regions. Miss A, Mr. B, and Mr. C are eager to seize these opportunities, but they realize that they'll need additional capital to fund new projects and expand their operations. Miss A is still the largest financial contributor and offers to invest another significant amount of capital. Mr. B and Mr. C are both hesitant about contributing more money. Mr. B wants to explore alternative financing options such as seeking loans or outside investors. Mr. C, on the other hand, suggests bringing in strategic partners who can offer both capital and business expertise to help scale the company. The three members have different visions for the company's future funding strategy, and their operating agreement remains vague about how to resolve such situations, leaving them in an impasse. Tensions rise as Miss A presses for her proposed capital contribution, while Mr. B and Mr. C disagree with the direction and the lack of clarity on how these new contributions will affect ownership percentages and profit sharing.
So not a unique situation at all. The company is growing. You need capital to continue expanding. And then how do you get that capital? How is it financed? How is it sourced? If it comes from an existing member, Tori, I'm going to pick on something that you already said. There's a difference between ownership and profit distributions. Now you're contributing more. What does that mean? And so there's a ton to unpack here. And again, while it seems like it's outlandish, almost every business at some point or another needs capital to expand and grow.
Right.
And how do you navigate that without making mistakes?
It is like you said, it's a common situation that obviously merits discussion among the members first and foremost, right? There are a lot of different ways to put money into a company. One is certainly a possible loan from Ms. A. And notice I'm using the word loan, meaning that it doesn't increase the ownership or alter the possible proportions of distributions. Ms. A would be a lender of the company, execute a promissory note. She gets paid in the regular course like any other lender. That's one way to do it. Another, maybe perhaps even more neutral way to do it would be looking at a bank or a credit union or some other entity to get a loan. And that happens all the time also, right? So if we're looking at the third possibility of additional capital, what that would do, it wouldn't alter their ownership percentages to the extent they've agreed on them in the first place, but what it would do is alter the proportions of the profits and losses. If we're increasing her capital contribution from 60 to say 65%, then she's going to be entitled to a greater proportion of profits and losses. What they may also need to do is amend their operating agreement. These things aren't written in stone. Operating agreements get amended all the time for any number of different reasons. They may need to amend it so that they are specifically addressing how to increase or how to get money into a company. Let me go back to that question.
Well, I mean, so it's actually a good point that you just made there that I don't think most people realize is that these operating agreements are not set in stone. In
Right.
fact, it's actually very good practice to amend them as the business evolves.
Mhm.
Hopefully in this scenario, they have language written in there to address, disagreements and how things are funding. But if it doesn't, you can amend the agreement as the company grows and says, all right, well, now we need additional capital. How you set it up? The biggest question then is hopefully when you get the member approval, you've already have language in there on voting rights and requirements and all those things. But now you're all sorts of issues if you don't, because then it goes back to the state laws that you were just talking about and unanimous. And but it's not a set in stone. We did this in the very beginning. Now we just forget about it.
Exactly. But certainly, at the very least, they should be talking about how to handle this and really looking at the um, advantages, disadvantages, consequences of any particular action.
Right.
So yeah, nothing's set in stone. The operating agreement can be amended, but they need to be talking about what happens as a result and thinking about the future as well.
Right. So Hannah, why don't you jump to the next slide here? Let's see what kind of questions we put together for this and go through. So the first one here, talking about that operating agreement and how it doesn't resolve those disagreements. I think, Troy, you answered that eloquently. It's a living, breathing document. It's
Right.
not static. It's dynamic. You need to be reviewing it constantly as the company evolves and changes.
Indeed.
The second one here with investing more capital into the company, how should ownership percentages and profit sharing being adjusted? Well, it depends on how it's contributed. If it's a loan,
Exactly.
nothing changes.
Right.
If it's a capital contribution, usually you see a lot of people just do a simple mathematic formula and saying, all right, well, I'm adding this, I'm now this percentage, and the same thing on the profit share. But let's say that Mr. B and Mr. C didn't want to go down that route. Are there any other ways to go about saying, all right, we're going to adjust things, whether it's setting up special distributions, priority returns, those different things? Say, all right, you're putting in more money, but we're going to give you 10% off of the top here, whatever that is, before we then split up our ownership. So if I'm understanding it, there's any which way you can slice it. to make it beneficial to the company as a whole.
That's exactly right. And I hope that our listeners are hearing the words that we're using: loan, capital contribution, some of the other forms we talked about, because I've seen litigation occur over what exactly we know that this person gave money to the company,
Mm-hmm.
but in what form was that money given? Was it a loan? Was it a capital contribution? Was it an investment from a third party thinking that that party would become a member of the company? Without determining exactly what the form of that money is when it's given, it can give rise to any number of different kinds of disputes. I gave you $20,000 thinking that I was buying into the company. I gave you $20,000 as a capital contribution, not as a loan. And it's when we have that ambiguity in the beginning, when people aren't being very clear about what they're giving and executing the proper agreements, you can have some very serious, expensive problems. I don't think I'd be surprising anybody if I said that litigation is expensive.
Mm-hmm.
Litigation requires what I call litigation tolerance. Do you have the emotional bandwidth to devote the next maybe 6 months to several years litigating a case? Uncertain result. Do you have the money to fund litigation through trial, through appeal? If you don't have the litigation tolerance, it may be best to look for maybe informal ways of resolving something, maybe through mediation,
Right.
or mediation then arbitration. But nevertheless, the consequences of not making um, these funds clear can result in all kinds of wasted time and money. So it's best to think about what we're doing in the beginning. What form are these monies being contributed to the company? Otherwise, you get a whole host of other problems.
Right. And you pointed out it's not just the money, it's the time. If you're spending all this time with not only your attorney and their attorney going through it, that is time you are not spending focused on your business. That is
Exactly.
a problem, that is a recipe for disaster, and something that could have been solved very simply had it been thought through and not rushed in the very beginning. And then something on the third question here that a lot of people get nervous about is when you bring in a third and outside party into this to invest, and what are those legal and financial implications for bringing those outside investors? Because typically they're rather sophisticated, they have their own terms, and you could run into a whole slew of issues, whether it's dilution of ownership, voting decision changes. They want the operating agreement completely shifted and adjusted based on their terms, and then they want to make money, obviously, because they're investing in you. So do you talk about their buyout agreements and profit sharing arrangements and all that? So it's not this very simple of, here, I'm going to give you money and I'm going to be a silent partner every single time. It's, what are the other things there that people need to think about?
See, this is why I love talking with you, Yanni. Again, you hit on all of the right points very, very clearly. People often aren't looking to invest money, whether it's a venture capitalist or an outside investor or another company. They're
Mm-hmm.
typically not looking to just give money for nothing, right?
Exactly.
They may want, all of this may represent a shift in control, a loss of independence or reduction in independence for the three original owners. Having an outside investor can represent that loss or reduction in control. That third party, whether it's a venture capitalist, may want a very sizable percentage of ownership. Yeah, sure, we'll give you $10 million if you give us 60% of the company, 70% of the company. That's not an uncommon number. I don't have to exaggerate. I've seen things like that. Give us most of the company, you can have all the money you want. And you guys will be or become essentially minority owners or minority members. That's a problem. A strategic partner may not simply agree to a loan, or the loan could be for some relatively exorbitant rate of return or
Mm-hmm.
percentage of the profits. Where the company is, whether it really needs this money, if it's desperate for it, if it's looking to expand its operation, something good. If it's desperate, desperate situations often make people do things that they wouldn't ordinarily do if things were better, and that can be a problem. So, in my opinion, in my experience, it's unlikely that many investors are going to give up a lot of money without a corresponding sense of control. So, like you said, that may result in the amending of the operating agreement in a way that clearly dilutes the other owner's membership, their ability to control. And frankly, if you had an outside, very savvy investor, as you mentioned in the beginning, they're going to take an aspirational operating agreement and say, what is this? This is horribly written. We're going to insist on the clarity that we're used to operating under and completely alter the culture of the company as originally founded. There are consequences to something like this. Another possibility could be like a strategic partnership or a joint venture, and that has some benefits and it has some consequences too. It could represent, again, another alteration of control of the company. It means that there are more minds in the room that want their desires, their opinions heard and implemented. All of these represent a possible increase in dispute and therefore the need for dispute resolution, more agreements, more drafting, the cost of hiring other professionals to look at these things.
Right.
No matter what, it's important to be clear about the consequences of dealing with any particular party and not operating quickly out of a sense of desperation or exuberance. Being careful and being clear minded, having the proper professionals evaluate the consequences of any particular possibility, incredibly important.
Being methodical, taking your time, going through with a fine tooth comb, dotting your I's, crossing your T's, making sure that what you're agreeing to is what you want not only now, but into the future. Because last thing you want is to have rushed a decision based on the immediate gratification and then realize what you've given up in either the intermediate or long term, which we've seen quite a few times in various industries where an incoming party wants at minimum 51% for that controlling interest. And now a business owner who's used to only reporting to themselves has to explain why they need a new copier.
Exactly.
And little things like that. And for most business owners, that is the thing that will make them lose their minds.
Yep.
And so that is one that I've seen all the time where now they actually are reporting their reasons and rationales for those things. And
Well stated.
they didn't think about that.
Well
So
stated.
perfect. Let's on the need of time. Hannah, why don't we go to the next piece?
Let's do it.
This is part 3, dissolve or sell. As ABC LLC continues to grow, Miss A, Mr. B, and Mr. C find themselves at a crossroads. After years of successful operations, Miss A begins to feel that the company has reached its peak potential and decides the time has come to sell. She believes that selling to a larger institution could provide a lucrative exit for all the members, offering substantial financial rewards and the opportunity to pursue other ventures independently. Miss A starts exploring potential buyers, but Mr. B and Mr. C are not in agreement. Mr. B sees the potential for the company to continue expanding on its own using alternative financing methods and strategic partnerships, and he is eager to build the company further. Mr. C shares this sentiment, feeling strongly that they've worked hard to create a successful independent business and doesn't want to lose control by selling it out to a larger institution. The trio is now at an impasse, with Miss A pushing for a sale while Mr. B and Mr. C remain firm in their desire to keep the company independent. The operating agreement, however, is silent on the process for dissolving or selling the business, leaving the partners with no clear path forward. Again, tensions rise as Miss A grows more frustrated while Mr. B and Mr. C are unwilling to relinquish control of the company.
Shocker. I mean, this is, again, operating agreement, operating agreement, operating agreement. It's weird how we keep coming back to that. But this scenario is something that we see all the time, and particularly in companies that are trying to build out succession plans. You have somebody that founded the business, has now sold portions to their successors, and there's this large portion that's still left. In this case, Miss A said, look, you know what? I'm ready to be done.
Right.
I'm ready to go and I want my immediate gratification and let's go and do this. And I'm going to bring you guys with me and we're going to sell. Whereas Mr. B and Mr. C, it might not be enough for them to be retired. They also might be so young. It's like, what are we going to do with ourselves? And they're not ready to go and be done and have to go do something else, or to have another boss, as the other piece just alluded to, with someone else coming in outside. And if there's nothing here to explain, here are the options that we can go through, what do you do?
We have both seen this happen in any number of different scenarios, and it can be difficult. Like, as you said before, operating agreement, operating agreement, operating agreement. In the absence of anything in the operating agreement talking about that clearly, first and foremost, the members should and they have to discuss the matter. One obvious possibility is that Mr. B and Mr. C agree to perhaps buy the membership interest of Ms. A. If she wants to be done and wants to be cashed out, then maybe having, more than likely having the company valued, her her interest in the company valued, so they can arrive at a number, buy her out, and Mr. B and Mr. C can run the company. It's unlikely that Miss A would care at that point. If she's
Right.
looking for money and she wants to be done, then for her, it may be more a matter of really just finding the appropriate number.
Now, Troy,
Um,
how do you value that? I mean, what do you typically do? I mean, is it a formula? Are you getting a third party? What do you typically see the most?
and thank you for asking, Yanni, and you're right to ask, right? Um, Something like that is often specified in an operating agreement. What are we doing when the company needs to be valued? Um, the things I've seen vary from having it specified in the operating agreement that all the parties or all the members will agree to one company valuing the entity and that's it, or um, two companies being agreed to and them averaging their value, or two companies being brought in and they bring in a third, and that third company resolves the difference. There are a lot of different creative ways to do it,
Okay.
but often it still requires there to be an outside party. And there are companies that do business valuations. Period. I know a few that can be helpful. The process can and should be spelled out in the operating agreement, and that's important. And in lieu of that, again, they clearly need to be talking and agreeing on either a process for it or at least some neutral, agreed upon third party evaluator to do it.
Sure. So,
Uh,
in the interest of time here, Hannah, let's see what the questions that we have here. So the first one being that operating agreement, it's silent on that, and so potential sale, dissolution of the business, maybe that she just wants to be done and out and going and getting that with the original company back when they had trouble. It's like, I want to be with my friend and have my own side hustle and go do my own thing. But in the event that it is silent, what happens?
if it's silent, then again, Miss A could be bought out. Maybe Miss A can finance it so that she's buying her partners out.
Right.
There are a number of different things that can happen in this in the absence of wording or provisions in the operating agreement for it. Um, those are I think the main options.
Okay.
She can't force anything,
Right.
unfortunately.
Okay. Well, then, if Miss A wants to sell the company, but they disagree, what legal options they have to force the sale and set that up. So in other words, here, what we typically see a lot of that's written here is those rights of first refusal. Say, look, I have a buyer. And the way it's set up for the protection of Mr. B and Mr. C is that here's the number. It's all been agreed to. It's not some fictitious number. They're going to pay this for it. And you have the option to keep it in-house and with you, but this is the number. And that's usually what you see a lot of people cling to on that one when you have outside buyers coming in and Mr. B and Mr. C don't want to be tagged along
Right.
with it for that sale.
That's exactly right.
So it's a setup there. And then on the last one here, how can ABC LLC prevent future conflicts like this by revising their operating agreement? What key clauses? I think I kind of gave away one of them right off the bat there, which is that the rights of first refusal. What other things can you think of, Troy, that might be imperative to have in there as part of that?
You mentioned the important one, right of first refusal. That's a common provision. The other I could think of would be maybe a buy-sell agreement that,
Hmm.
corresponds to the operating agreement. And a buy-sell agreement has a similar kind of effect and function. It's meant to provide how a company can buy out a member or an owner, typically upon death or disability, but you can provide other provisions too if there's disagreement about the ongoing potential for the business if a partner wants to be or an owner wants to be brought out or bought out. And it's often backed by insurance, so funding isn't the problem. Also, um, yeah,
It's interesting to actually bring that one up because that's the one we've run into, I think, the most is what people don't realize is you have a partner and their spouse. And partner, Miss A, pick on her because she's the main shareholder there in this scenario, passes away. Now Mr. B and Mr. C could potentially be partnered with Miss A's spouse if it's not set up properly. And you didn't get in the business to be with the other person there. So that buy sell agreement sets up so that number one, the shares might have to be sold. You have your fair valuation. And to your point, if there's life insurance, hopefully that the company has owned it. You have some set up there. They purchased it. It's taken care of. Where now the company owns it. You buy the shares and everything's handled. The spouse gets the money. You get the ownership. Everybody's happy, minus the psychological fact that Miss A is no longer with us. But it solves a lot of those issues instead of having someone who you might not want to be in business with as your potential main shareholder.
exactly. You married the person you married, not somebody else that you didn't know about at the time.
Yeah, it's so that's an interesting one. So rights of first refusal, buy, sell. There's also usually you see there might be some exit strategies that we've seen. For a lot of intellectual businesses, financial firms, lawyer firm or law firms, those type of things, you see where they have age banding. So in other words, here with the shareholders, at a certain age, underneath that, you have to give X number of years notice that you are retiring, and we
Exactly.
get that process. So number one, transfer of intellectual property, transfer of assets, we figure all those out. And over a certain age, the same thing, but it's all baked in there. So there's not this big surprise one day. And
Exactly.
so having those exit strategies in, not only for, you get bought, you sell it, or if something happens, death, disability, as you mentioned, financial distress, but just for the happy one, you're retiring and graduating in the next set of your life, and what you want to
And,
do there.
and that's exactly right. What we've talked about is really the lifespan of a company, the beginning, middle part, some of the issues that can come up, and equally as important is what you just said, exit strategy. What is our plan for business succession? What are our thoughts on it? How do we plan on doing this? And I think you mentioned the right word, not days, not months, not weeks, but years. Two
Mhm.
to 5 years is a good time frame to begin to implement that exit strategy. And again, implement, not think of, but implement or execute. It's something that should be thought about beforehand. It can be revised, but certainly there should be one.
Yeah, and so this is all incredible. We've got about a minute and a half left, and so my takeaway from this is that most people start a business because they found a passion that gets them excited. And our role as the legal and financial experts in our fields is to keep them out of the weeds and focused on what they love. So, to everybody listening to this and watching this in the future, if you're thinking about starting a business or have one up and running, give us a call so we can either get you started on the right foot or help you protect what you've already built.
Indeed.
So, Hannah, with that, any closing remarks?
Unfortunately, we don't have time for questions, but like Yanni said, their email is up on the screen. So please give them an email if you have any questions or comments about what you guys just heard.
Perfect. Hannah, I appreciate you doing that for us. And Troy, it's always fun talking with you.
Yanni, you too. Thank you for everything, Yanni. Thank you, Hannah. This has been fun. Hope everybody enjoyed it.
Thank you,
Take care.
guys.
Take care.